In the ever-shifting landscape of global finance, the Bank of Japan finds itself at a pivotal juncture, delicately navigating the path toward policy normalization. As the nation's central bank convenes for its highly anticipated policy meeting this week, all eyes are fixed on the potential implications for bond purchases and interest rate hikes, moves that could reverberate across Japan's economic fabric and ripple through international markets. For years, the Bank of Japan has been a bastion of extraordinary monetary stimulus, employing a vast array of unconventional tools to buoy the nation's sluggish economy and combat the persistent specter of deflation. Yet, as the winds of change sweep through the global financial arena, the time has come for the BOJ to contemplate a recalibration of its approach, a delicate balancing act that demands prudence, foresight, and a deft touch. At the heart of this week's deliberations lies the prospect of reducing bond purchases, a move that would mark the Bank of Japan's first tangible step toward quantitative tightening since embarking on its policy normalization journey in March. According to insiders familiar with the matter, the central bank is expected to weigh the appropriateness of trimming its monthly bond acquisitions, currently hovering around 6 trillion yen, $38.2 billion, in a bid to enhance the predictability of its operations. This potential move, while modest in scale, carries profound symbolism. It signals a gradual shift away from the BOJ's decade-long embrace of aggressive stimulus measures, a departure from the era of yield curve control that saw the bank exert an iron grip on long-term interest rates through unprecedented market intervention. Yet, as the BOJ contemplates this pivotal step, it must tread carefully. The bond market, long accustomed to the central bank's unwavering presence, could react with volatility to any perceived misstep. Lessons from the bank's surprising reduction in bond purchases on May 13, which caught traders off guard and sent shockwaves through the market, linger as a cautionary tale. The stakes are high, and the delicate dance of policy adjustment demands finesse. Any shifts in debt buying, according to those privy to the discussions, will be gradual, staged, and communicated with utmost clarity, a departure from the rigidity of the past, emulating the Federal Reserve's approach to transparency and market engagement. But the bond market is not the only arena where the BOJ's actions will reverberate. The yen's recent volatility has added another layer of complexity to the central bank's deliberations. Governor Kazuo Ueda, while reiterating the bank's stance of not explicitly targeting exchange rates, cannot ignore the currency's tumultuous path, a path that has drawn criticism and prompted the government's largest-ever currency intervention in support of the yen. As the yen reacted to weaker-than-expected U.S. inflation data and the Federal Reserve's pushback on rate cut expectations, its gyrations served as a reminder of the intricate interplay between monetary policy, exchange rates, and global economic dynamics. The yen's response to Friday's BOJ decision will be scrutinized with heightened intensity, with market participants seeking to decipher any signals concerning the currency's trajectory. Furthermore, the specter of an impending interest rate hike looms large. While the consensus among economists surveyed by Bloomberg indicates that the benchmark rate will remain anchored between 0 and 0.1% this week, a significant minority, one-third of respondents, anticipate a hike as early as July. This anticipation, fueled by persistent inflationary pressures exacerbated by the yen's weakness, underscores the delicate tightrope the BOJ must walk. As Governor Ueda takes the podium for his much-anticipated press conference, his words will be dissected for any clues about the central bank's future policy path. The statement accompanying the policy decision is expected to be lengthier than its April counterpart, delving deeper into the BOJ's assessment of the economy and inflation dynamics, a reflection of the heightened scrutiny and the multifaceted challenges facing the central bank. In this intricate dance of monetary policy, the Bank of Japan finds itself at a crossroads, navigating the path toward normalization while contending with the complexities of bond markets, exchange rate volatility, and inflationary pressures. It is a journey that demands precision, dexterity, and a keen understanding of the intricate web of global financial interconnectedness. As the world watches with bated breath, the BOJ's actions this week will resonate far beyond Japan's borders, serving as a testament to the delicate art of central banking in an era of unprecedented challenges and uncertainties. Whether the bank can strike the perfect balance, tempering market volatility while laying the foundations for a sustainable and stable economic future, remains an open question, one that will shape the narratives of both Japan's and the global economy for years to come.